With the debt default now a thing of the past, and the Fed's relentless federal funds rate increases coming to a pause, it should be a win for the Treasury markets and mortgage interest rates, right? Wrong. And housing, a key factor in the federal funds rate decisions by the Fed, seems to still be coming in hot, data-wise. Also, in many locations around the United States, median home price sales data is coming in higher, regardless of where mortgage interest rates are at. Crazy times and data to boot. However, with all the positive news about the debt ceiling and the federal funds rate, why didn't mortgage interest rates drop back down? And in a decent fashion. Stick around to this video to find out more. Well, welcome back after that quick break, everybody. Mike Petras here with MPRE Residential, powered by NextHome Treasure Valley, and welcome back to another video to where we're going to go ahead and discuss one of the biggest questions I've been getting as of late, and that is, Mike, why aren't mortgage interest rates coming back down? With all the positive news that seems to be coming lately, with inflation on the way down, etc., why wouldn't it? That is a very, very good question to ask. And if you do stay in tune to the markets like I do, you probably already know a lot of this information and know what's going on. But if you don't, please stick around for this. Be more than happy to break it down for you and let you know what is still rattling the markets out there. But before we do break into that, of course, if you are looking to make a relocation right here to the greater Boise, Idaho area, better known as the Treasure Valley, please feel free to give me a call, shoot me a text, send me an email. Would love to be able to come up with a perfect game plan to go ahead and get you right here. And of course, if you're looking for more information before you decide to make that move, please click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Also, please feel free to hit that subscribe button below, hit the notification bell so that you're constantly in tune with all the videos that I do come up with, and please give me a thumbs up if you enjoy this content. So before we break into the reason as to why mortgage interest rates have not come down the way that everybody's expecting them to, let's go ahead and briefly take a look at the data that came in over last week, especially the CPI data. And again, if you do follow this information on a daily basis like I do, this is going to be old news to you, but it is very, very relevant. As you can see, the year-over-year CPI data has come down actually quite significant, 90 basis points, almost a full 1% drop that we had before, now hovering at 4%. However, the core monthly CPI did not come out all that well and fared well. So in a nutshell, and as not to bore everybody watching this video, inflation is still sticky, which in turn leads to defensive positions in the markets. Although that data, plus what is going on in the job markets, etc., is really what put the brakes on the Fed to go ahead and raise the federal funds rate again, and all that good news that followed, unfortunately, the Fed also released their SEP report, or the Summary of Economic Projections. Of course, right? Why have any comfort at all in the markets? So let's go ahead and break down that statement, Summary of Economic Projections. This is the projections of where the Fed thinks the federal funds rate will be at year's end 2023. And what did they say? They said that they expect another 50 basis point hike in the federal funds rate before the end of the year. In essence, and in my humble opinion, this is the way that the Fed goes ahead and bounces back against the markets, especially considering that the markets, well, back some months ago, was fighting back against the Fed. But again, it's the Fed's projections on where they think the federal funds rate is going to land. So what is this indicating to the markets? That the Fed is going to get more aggressive coming up. Stricter financial policy. And what does that do to the Treasury markets? It keeps them on the defense. But why? It's because longer-term rates, like those for mortgages, are far more interested in the forward-looking trajectory of the Fed's rate path. And this instance of the dots was far more interesting this time because it was a look into whether or not the Fed has reached a ceiling with the federal funds rate or they continue to move forward aggressively. And on that topic, the dots really indicated to the markets that there's going to be another 50% basis point hike, which is 2 more hikes before the end of 2023, indicating that the Fed is not done. Now, the markets were initially unhappy with the Fed's stance of moving forward with tighter aggressive policy. Initially, but the markets also did find some solace in what the Fed, Jerome Powell, had said during the press conference. In it, he offered his typical reminder that the dots are really projections and not future predictions or indications or forecasts. He even went on to say that the FOMC hasn't even really decided whether or not they're going to do it at all, saying that they would look at it on a meeting-by-meeting basis and how the data is going to come in through the future. So in essence, what he did was he played wishy-washy with what their projections are on paper with the SEP, and then said something and kind of retracted against it a little bit. And what have we noticed across the months when it comes to the Fed? Yeah, they like to install that confusion. And again, what do we know when there's confusion around? That's right, the markets will stay defensive. And they have been as of late. So will the Fed continue the pause in the federal funds rate increases, or will the new SEP report really kind of come to fruition? Unfortunately, it is a guessing game considering that previous hikes in the federal funds rate have a lag to them instead of an immediate effect on the economy. Will the data moving forward come out better? However, and in the meantime, expect the markets to remain tense when it comes to their stance, and they're going to be waiting on what's going to happen with the upcoming CPI report next month and the upcoming PCE. Some good news on the employment side is the federal funds rate seems to be working as of late, with initial jobless claims on the rise, saying unemployment. However, on the other side in the core CPI, we know that housing is on the rise, and we can actually see it in the median home sales price across various locations in the US. This is something that the Fed does not want. And why is that basically happening? Because there are shortages in inventory in these areas across the US. However, there is inventory increases also happening across the US in the housing market. So what could we really kind of expect? More of a stabilization pattern, like I've said in previous videos. And if you haven't seen those videos, please hit the subscribe button below, hit the notification bell so that you're constantly in tune with all the videos that I do come up with. But there is also a flip side of that coin, meaning that the Fed continues to raise the federal funds rate. It'll just put more pressure on builders to be able to go ahead and start new projects, thus keeping inventory low. Or simply, new builders will just pass on any kind of expense, additional expense that they have onto the consumer. Either direction though, and looking at the data, we can see that the broadsword of the federal funds rate is actually working. However, the Fed is setting up their safety net in the SEP by basically saying that not everything is hunky-dory as of yet. So if you've been on the fence hoping for mortgage interest rates to come back down, or it's kind of pushing you out of the market just because of that slight little teeter, maybe into where it's at right now, I would not expect the mortgage interest rates to come back down as of yet until the data gets better. Because what do we need? We need the markets to feel at ease. Instead, what can we possibly see until the PCE and the next CPI comes out? Volatility swings, like we've been seeing for some months now. And in my humble opinion, if mortgage interest rates start coming back down, expect the Fed to sell off more of their balance sheet even more briskly. And what could that possibly do? Keep mortgage interest rates hovering about where we've been at. But with all of it, we'll just have to wait and see. So buckle up for more of the waiting game. However, buyers, like I've said in previous videos, if you are hoping and expecting rates to come back down into the 3s or maybe even the 4s like we had previously, I wouldn't expect that at all and anytime soon. And why? Because of that leverage in the balance sheet that I had just mentioned. As of today, the Fed is still holding on to trillions in Treasury debt, and they want to get rid of as much as possible. And in order for them to sell it off, they're going to have to take a price reduction. And when the price of the bond falls, we know that the yields go up. And what do mortgage interest rates follow really, really closely? Especially the 10-year Treasury note. That's right, the yields. And as the yields are up, expect mortgage interest rates to follow the same. Minus all the doom and gloom of the mortgage interest rates and where they're at right now, though, mortgage interest rates still are historically low overall. And with home prices back on the rise potentially, if you do find yourself in a position to buy or think that you can qualify, please feel free to reach out to me. Be more than happy to have you talk with one of the professional loan officers around here in the Treasure Valley in order to set that foundation for you. So please feel free to reach out to me. Be more than happy to go ahead and talk this over and set you in the right direction. And of course, if you're looking to do that, please feel free to reach out to me, give me a call, shoot me a text, send me an email. I can be reached at 208-715-0915. 7827, or you can reach me via email mpetras@mpre.homes. Also, if you are looking to begin your home search, please visit my website at www.mpre.homes. And if you are looking to make a move from out of state, say here to the greater Boise, Idaho area, better known as the Treasure Valley, please click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Also, before you go, please hit the subscribe button below, hit the notification bell so you're constantly tuned with all the videos that I do come up with, and please give me a thumbs up if you like this information, you found it useful. Also, feel free to comment below with any questions that you do have. More than happy to respond to those, but I also would love to hear what you think regarding what is going to happen in the housing markets and even with mortgage interest rates coming up in the near future. So I look forward to the day that we speak. I look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.